Welcome to Argunas Learn. Last time, we talked all about building an investor's risk profile. But, a risk profile is just an idea on paper. How do you actually turn that into a real working portfolio? Well, the answer is asset allocation. This is the absolute backbone of investing. It's the critical step that connects who you are as an investor to where your money actually goes. And honestly, it's the reason good portfolios can ride out the market's ups and downs.
So, let me ask you something. Take a look at your own investments. Is your portfolio built on a solid foundation, or is it more of a random collection of things you've picked up over time? See, building a portfolio without a clear asset allocation strategy, it's like trying to build a house without a blueprint. You might have the best bricks and the best wood, but without a plan, that structure is weak, and it's probably not going to survive the first big storm. Asset allocation is that essential blueprint for your financial future.
Okay, so let's get into this blueprint. Here's what we're going to cover. First, we'll tackle the big question. What exactly is asset allocation? Then we'll look at the two main ways to do it, strategic versus tactical. After that, we'll unpack the powerhouse of discipline, something I call the power of rebalancing. Then we'll see how this all works in the real world, and finally, we'll wrap up with what you really need to know from an NISM exam perspective.
So, let's start at square one. What is asset allocation? Like we said, it's the master plan, the blueprint that gives your investment structure and a real purpose.
Now, if we look at the NISM study material, it gives us a really clear definition. It says asset allocation is a process of allocating money across different asset categories. Think equity, debt, gold, in line with a stated objective or goal. The two words to really focus on there are process and objective. This tells you right away it's not a one-time thing you do, and it's definitely not a product you can just go out and buy.
And this is the key. It's all about having a structured process that's tied to a clear objective. I mean, think about it. Most of us have our money in a few different places, right? Some stocks, maybe an FD, a bit of gold, but so often there's no logic to it. It's just random. And that kind of random investing usually fails because it isn't connected to any real goal, and it leaves you making emotional decisions the minute the market gets a little shaky.
Okay, so you're on board with having a process. But how do you actually go about it? Well, that brings us to the two main approaches for building your portfolio, strategic versus tactical allocation. You can think of these as two different architectural styles for your financial house.
This table does a fantastic job of laying out the difference. Strategic allocation is your long-term foundation. It's the plan that's tied to your big life goals, like retirement. It's stable. You set a target allocation and you stick to it. For pretty much every investor, especially if you're just starting out, this is where you begin. Tactical allocation, on the other hand, is much more dynamic and short-term. The goal here is to kind of dance with the market, deviating from your target to try and squeeze out some extra returns from short-term opportunities. As you can guess, this is really for more experienced investors who have a deep understanding of market cycles.
Now, it doesn't matter which approach you take, strategic or tactical. There's one mechanism that is absolutely critical to keeping your plan on track. It's the thing that protects you from yourself. I'm talking about the power of rebalancing. I like to call it the discipline engine of your portfolio because it's a powerful tool that fights our natural human tendency to get greedy when markets are up and fearful when they're down.
So how does this engine actually work? Well, it's a beautifully simple four-step process. Step 1. You set your target. Let's say a simple 50% in equity and 50% in debt. Step 2. The market does its thing. Let's say stocks have a great run. Your portfolio will naturally drift, maybe to 60% equity and 40% debt. Step 3 is where the magic happens. You rebalance. You sell some of the asset that did well, the equity, and you use that money to buy the asset that didn't do as well. In this case, debt. And what's the result? Step 4. You're right back to your original 50-50 target. You've restored the balance.
And this quote from the NISM material captures the logic perfectly. Rebalancing would mean selling the asset class that has done well and buying the one which has not performed as well. Now think about that for a second. It feels totally counterintuitive, right? Our gut tells us to let our winners run and maybe sell our losers. But rebalancing forces you in a very systematic way to do the exact opposite. It automatically makes you sell high and buy low without any emotion or guesswork involved. Let's just run through a quick example with numbers to make this totally clear. Say you start with 1 lakh rupees. Your target is 50-50, so that's 50,000 in equity, 50,000 in debt. Then the market moves. Your equity grows 20% to 60,000, while your debt stays put at 50,000. Your total portfolio is now 11,000 rupees, but your allocation is out of whack. To rebalance, you need both parts to be 50% of the new total, which is 55,000 each. So what's the action? Simple.
You sell 5,000 rupees of equity and use it to buy 5,000 rupees of debt. And just like that, you're back at your target, having locked in some profits and bought the other asset a little cheaper.
Okay, that's the theory. Sounds great on paper, but what does this actually look like in real life? Let's take a look at allocation in action, from someone starting their first job all the way through to retirement.
This slide paints a really clear picture with two classic examples. On one side, you have a young earner, maybe 30 years away from retirement. What's their main goal? Wealth creation. They've got a long time horizon, so their ability to take on risk is high. For them, a typical allocation would be aggressive, something like 80% in equity and 20% in debt. Now look at the other side. Someone nearing retirement, just 5 years to go. Their goal has completely shifted to capital preservation and income. Their time horizon is short and their risk ability is low, so their allocation is a mirror image. Maybe just 20% in equity and 80% in debt to keep their capital safe.
And this brings us to one of the most important takeaways from this whole discussion. Your asset allocation is not something you set once and then forget about. It cannot be static. It absolutely must evolve as your financial goals, your time horizon, and your life stages change. Getting married, having a child, getting a big promotion. Any major life event should be a trigger to sit down and review your asset allocation.
All right, for all of you who are here preparing for the NISM VA exam, let's zoom in on what you absolutely need to nail down. This is the exam perspective.
When it comes to your exam, these are the points you need to have locked down. First, burn this into your memory. Asset allocation is a process. It is not a product. Second, you have to know the difference between strategic, which is long-term and goal-based, and tactical, which is short-term and opportunistic. Third, and this is a big one, you need to master the logic of rebalancing, selling winners to buy losers to maintain your target. A really common mistake is to underestimate how important rebalancing is for discipline. You should absolutely expect some scenario-based questions that test this exact logic.
All right, let's do a super quick recap of everything we've covered. 1. Asset allocation is a disciplined process tied to a specific goal. 2. It's the bridge that turns your risk profile into a real portfolio. 3. Strategic allocation is your long-term game plan. 4. Tactical allocation is for short-term adjustments. 5. Rebalancing is your discipline engine. It forces you to buy low and sell high. And finally, 6. Your allocation has to change as your life changes.
So we'll end with this thought. You now have the blueprint for building a really strong financial portfolio. The only question left is, how will you make sure you build your future with the discipline that this blueprint demands? That's it for this concept on Argunas Learn. In our next videos, we will see how these principles apply inside mutual funds. If you found this breakdown helpful, please do like this video, subscribe to the Argunas Learn channel, and hit that bell icon so you don't miss our next explainer. This video is for educational purposes only. It is not affiliated with, endorsed by, or sponsored by NISM, AMFI, or SEBI. Mutual fund investments are subject to market risks. Please read all scheme-related documents carefully before investing.